This is the Friday, December 7th, 2018 version of the Market Plus segment. Joining us now is Ted Seifried. Ted, welcome back.
Hey, Delaney, thanks for having me.
Ted, let's start out the discussion here in Market Plus with oil. I know you wanted to make sure we squeezed that in here.
Yes,
let's talk about the OPEC cuts that we saw in Russia, Saudi Arabia, OPEC countries. What's that going to do for our oil markets?
Okay, so OPEC decided, and also non-OPEC countries such as Russia, decided that they're going to cut, beginning January 1st, 1.2 million barrels a day of their production. It's a sizable amount. It's not a number where we're going to see crude skyrocket on those prices, but it should be supportive for crude. Now, the big thing is that our production has gone up significantly between the Bakken and the Permian. And so we still have a lot of crude oil, and our stocks will probably continue to build. But the crude oil, the global crude oil market should be elevated by this. And I think that should put in low for crude oil at this point. Also, it comes at a really good time, in my opinion, because if you look at a weekly continuous chart and a monthly continuous chart, we have a ton of trend line, long-term trend line support right here at this psychological $50 support level anyways. So in my mind, this is likely an area where we're going to see crude oil try to find a bottom and try to have a bit of a bounce. I see a target of about $62. I think it's a good time to be booking springtime and even into summer energy needs for producers. But I see upside potential here. And I think the OPEC cuts were due to happen. Russia, non-OPEC countries, but Russia in particular, have good reason to want to cut back as well, help stabilize their ruble. They're also seeing food and energy prices domestically kind of skyrocket, and they need to temper that by lowering their output, which you might see them follow through on wheat with that too, so keep that in mind. But yeah, I'm bullish crude oil from where we stand right here. I think we've gotten a little too far to the downside, and I think we can have a nice recovery.
When are we going to start to see those prices then reflected at the pump, Ted?
Yeah, that's a good question. I mean, it's going to be a fairly immediate thing, right? Fortunately, you know, we're not on the summer blend right now, so the pump's not as big of a concern as what our heating bills are. You know, the heating oil aspect of it is what, you know, so diesel there, but. That's the bigger problem, or the bigger price sensitive this time of year. But that can be reflected almost immediately once crude starts to go higher. And I kind of think crude is ready to do that now. So I think that could happen pretty quickly.
So definitely be locking in those spring and summer
well, nothing's ever
needs.
definite, Delaney, but I think it's a good time to be looking at it. And based on where we were just a few weeks ago, a month and a half ago, we were $25 higher. I mean, hey, if you're doing it now versus then, you're a lot better off. You know, and at $50 crude oil, how much more downside do we really have from here? So yeah, it's sort of a no-brainer to get at least a good portion of that locked in. Perfect.
Ted, let's take some social media questions. We've got quite a few this week. We're not going to talk about hot dogs on the show during Market Plus. I know that's a favorite. We've got the first one here, Ben in Rochester, Minnesota. He said, if 2019 starts out with world peace, African swine fever disappears from our dialogue, and China buys hogs like they did the past 2 years, where do summer hogs trade?
That's an interesting question. World peace, well, that would be fantastic. What does world peace do for commodity prices? It certainly takes some uncertainty out. Generally would mean that the population growth would continue. So long term, that's really quite bullish. I think the key there to that question, though, is African swine fever versus China buying normally like they had in the last 2 years. I don't think you want to take that out of the equation, because I don't think you can take that out of the equation. But all right, in a world where that doesn't exist, I think we're very well priced for good Chinese demand. But we might be overpriced for non-ASF Chinese demand. If ASF continues, as it most likely will, and we start trading with China normally without the 62% tariff, I think that June hog contract has a good chance of going and testing par, testing 100. That's the upside level. If you go back to, what, 2015, late in 14, we were up in the upper 120s, upper 130s. I don't see that really happening. It depends on how bad ASF is in China. But I do see upside mobility. I'm more interested in what happens with the Feb hogs compared to where June is, because you've got a huge spread going on there with the deferred months trading sharply higher. And that is because we're factoring in more export potential because of ASF. But that's not how bull markets work. And as we rally higher, that front month should be finding more strength. Now, if China's going to start buying hogs now, which we've seen that already without the tariffs going away, in the last 2 weeks they've been on our export sales sheet, I think that Feb has more work to do to sort of catch up to the deferred months. So that's where I'm the most interested in right now, is that Feb hog contract.
So you expect to see February coming back up to the deferred month levels?
Yeah, really the only thing holding Feb back is cash, but cash can move very quickly if China is going to be a consistent buyer, despite the fact that they have 62% tariffs on us.
Ted, what's going on with the African swine fever? We haven't really heard any new cases updates, outbreaks, anything like that.
Yeah, we haven't heard anything.
Right. I understand.
Who
China,
knows what that means, right?
I guess is the market still factoring that in as a main factor, a main driver right now?
Well, Delaney, I think the loudest thing that we've heard about ASF in the last couple of weeks has been the export sales that we are selling pork to China, despite a 62% tariff.
Right.
62%. Think about that. If you went to the grocery store and somebody told you that, oh, hey, you can have this, but it's 62% more expensive than what the price says on it, would you still buy it? No, not unless you absolutely need it. Okay, so I think that says boatloads right there, and that's why I don't think ASF is going away anytime soon. I think they're having a really hard time controlling it. I don't think they're going to be able to, and I think there's a very big problem there.
All right, let's change tracks here. Taking a question from Matthew Pott in Ontario, Canada. If you could know the answer to one thing about the wheat market fundamentals right now, what would you want to know?
Oh, well, hi, Matt. Interesting question. I mean, rather obviously, I'd like to know where the price of wheat is going, so I can place orders for that and go trade from a desert island, and then I can have you guys come and shoot the show from there. No, but yeah, I mean, that's a very good question, Matt. There's a number of things that could happen for wheat that I'd love to know if that's going to be the case or not. But I think the number one would be Russian wheat exports. Their domestic wheat prices are getting pretty pricey. They've said that they're not going to limit their exports in any way. But I wonder about that, and if Russia were to limit their wheat exports, that would be fairly explosive for the wheat market.
Absolutely. Ted, we've got another great question in here I want to make sure we cover because we didn't get to talk about it during the main program. Glenn in Bryan, Ohio says, with private estimates having the Brazilian crop as high as 130 million metric tons, do we still have structural competition problems from massive soybean carryover stocks, even if China removes its U.S. import tariffs?
Yeah, so we talked about this a bit in the show. We have a problem with competition, period. And Brazil and Argentina have been encouraged greatly so to increase their production, which is why you've got some of these very large production estimates coming out. I'm not quite that high yet, by the way. I mean, there's still a lot of growing season left, but it looks very good right now. But as we were talking about, if China were to come back in and buy, if they're just buying based on their needs, I don't think it is enough in the window that we have for our exports to really impact our balance sheet enough. Again, we need 10 million metric ton sales to China next week to just catch us up to be able to get into a position where we can get to the current USDA estimate. If we're going to start knocking away at that ending stocks number, we're going to need to see China come in and buy above and beyond what their actual needs are, meaning the whole idea of the olive leaf. They're going to close the trade gap by buying more than what they need, just buying basically just to buy, just to make us happy, really. And so if they were to come in and buy 30 million metric tons of soybeans, that makes a big difference. That is a game changer, and there is upside potential. If that doesn't happen, we're still looking at a record carryover by a long shot. I don't think that changes things. I think we still need to see soybean acres come down, maybe not as much as what we were originally thinking, but, you know, we'll see. Now, interesting idea there, though. If China does come in and buy 30 million metric tons of soybeans from us, they very likely would be buying quite a bit less from Brazil. And how funny would that be, or ironic, I think is the better word, when Brazil goes in and plants all these soybeans and has a fantastic crop, and then all of a sudden China is having to buy more from us, and they're left with all these soybeans. And then, you know, but the problem there is then their soybeans get very cheap. And then, you know, we talk about demand displacement from, you know, when China moves all to Brazil, then we get all the other countries in the world. Well, if China comes more to us and Brazil gets cheap, we'll lose all of our other business. So it's not a good, it's not 130 million metric ton down in Brazil, 130 million metric ton crop down in Brazil is not a great thing for anybody. And it suggests that the world as a whole is now starting to overproduce soybeans and maybe oilseeds in general. So we need to cut back on acreage, us and also South America.
So with all of that being said, we've got the Brazilians CONAB report coming out next week. What are you expecting to see for those production numbers?
Well, you know, we're going to see that right before the USDA's report, and we'll see what the USDA has to say on it, and they, a lot of times, are sort of in tandem. I'll tell you what my expectation is for both of those, or the number that I've released. I'm at 122.4.
Okay.
That's where I see us right now. Again, you know, we're early enough in a growing season. It's a big area. Some is a lot further along than others, but the vast majority of their growing area still has enough time for things to happen. You know, certainly we've seen a lot of damage done to soybeans at the end of a season. I'm not going to that 130 number yet, but I am continuing to move mine. I have been continuing to move my number higher. All
right, Ted, I'm going to end on one final question here. We've got Minda in Texas. We talked a little bit about this during the main program, but is it realistic to anticipate that China will import our corn? I assume she's talking about if we have trade relationships improve.
Well, hello, Minda. Is it realistic for China to import our corn? Wow. Okay, so they traditionally China imports a little bit of corn here and there, and it's mostly logistical to get to ports that aren't easily accessible from their internal transportation systems. But I think the question is, are they going to buy corn in a massive way? First of all, I think we have a better shot at ethanol for reasons we talked about in the program.
The finished product ethanol sent out to China?
Yes, the finished product ethanol, because they have a real need for ethanol and they don't have enough facilities to turn around and produce the ethanol with all of the corn that they supposedly have. DDGs would be the second opportunity. You know, they have an anti-dumping policy on our DDGs, but if they're looking for alternative feed rations, and either way, I mean, it's a good feed ration. So that would be another, but the ASF might cause a problem for that. Mm-hmm. For corn itself, this is one of those things where it would really need to be one of two things. Either they are being untruthful about the stocks that they have. The stocks that they have are really not good. You know, that one of those two possibilities. Or it's, again, that olive branch idea that they're going to buy more agricultural commodities from us whether they need them or not. And that could include corn. And if it did, wow, that would be really very friendly for corn. But I'm not hoping for that. I'm hoping that they're going to come in and buy ethanol fairly aggressively. I'd love to see those ethanol margins perk up. I'm a big fan of ethanol as it is, but I would really like to see our ethanol demand as strong, if not stronger, for next year.
All right. Thanks, Ted Seifried.
Hey, pleasure's mine, Delaney.
Join us again next week when we'll explore one farmer's 6-year battle with the USDA over a swamp-busting allegation. And Don Rose will be at the market-to-market table. Until then, thanks for watching, listening, or reading. I'm Delaney Howell. Have a great week.